What's up, everybody? Today we're going to be looking at Uber and Lyft. We're going to be looking at the fundamentals for both these companies. We're going to model out some projections for the next 5 years, and we're going to try to decide if one or both of these stocks offers a good investment today. Now, as a consumer, I like both of these companies. I've used both Uber and Lyft, but today I only own one of these stocks, and by the end of this video, I think you'll understand why. All right, so let's get into it. Now, really quickly, just looking at the chart of these companies over the past few years, they paint a very different picture. Uber looks like has done quite well. Meanwhile, Lyft is way cheaper today than it was just several years ago. It's now, $10 to $20 range where it was, touching 60, 70. Today, Uber is just a much larger company than Lyft. Lyft, about $6 billion market cap. Uber, $177 billion market cap. Now, it might be surprising to people in the US especially that the difference in market cap is this big. I mean, Uber has more than 25 times the market cap of Lyft. Because in terms of market share in the US, Lyft is about, 25% of the market share and Uber is about 75. So our perception in the US is that Uber is only, 3-ish times bigger than Lyft. But Uber exists all over the world, whereas Lyft is mostly just US and Canada. They're trying to expand into Europe. We'll talk about that in a little bit. Also, Uber has Uber Eats. There really isn't an equivalent of that for Lyft. Additionally, Uber is growing a little bit faster and is more profitable than Lyft. So we can't just compare market share. Uber's trailing 12-month revenue is up to about $45 billion, and their margins are looking good. Look at this movement in margins. They were significantly negative. Uber never made money. And then in 2022, 2023, they flipped into profitability, and now the margins just keep on improving. This is something great about an asset-light business like Uber and Lyft. I mean, they don't own the vehicles. They have this app, they have the network, and if there are more drivers and riders on that network on a marginal basis with each rider and each driver that gets added on, that doesn't really marginally increase the expenses for Uber or Lyft that much, but it definitely increases their revenue. So as they scale out, you see an increase in margins. And as an investor, this is what we want to see. Operating margin and free cash flow margin just going up and to the right as revenue is also increasing. Now, looking at Lyft, we're seeing the same thing. Revenue's up to now about $6 billion, and their operating margin is about to flip into profitability. They've had massively negative margins, and now on a trailing 12-month basis, it looks like they're about to break even. And on a free cash flow basis, they've already flipped into profitability. In fact, as far as profitability is concerned, it looks like Lyft is following a similar trajectory to Uber. They're just about, maybe 3-ish years behind in terms of where their margins are sitting. I love finding companies like this that are just about to flip into profitability, where I expect the margins to improve over time as revenue scales up, but expenses don't scale up as quickly. Sometimes these moments when a company flips into profitability and shows that they can really generate a ton of cash, these can be inflection points for the stock. We saw that with Palantir. They weren't a profitable company until 2023 when they flipped into profitability and the stock just took off. We saw that with Uber as well. When they flipped into profitability a couple of years ago, their stock is up more than 3x from there. So Uber is the dominant, more profitable, larger player, but that doesn't necessarily mean that it's the better investment. Now, diving into their earnings, looking at Uber first, they're highlighting a lot of the things we were looking at. Profitability, margins increasing over time. They're focused on more than just ride sharing. They're focused on their merchants as well, so it's a little bit more diversified. They're looking at about 15 to 20% growth year on year. A little bit of a drop in Q1, but that's to be expected. Q1 is always a little less busy for these companies than Q4. Now, jumping over to Lyft, the story is similar, but on a slightly smaller scale. Gross bookings are up about 13% year on year. Again, slight drop in Q1. That's to be expected. They have a whole slide showing off their free cash flow and really highlighting how they flipped into what looks like extreme profitability here. $920 million in free cash flow for a $6-ish billion company. That sounds like 6 to 7 times free cash flow, which would be dirt cheap for a company like this. However, this is kind of distorting the picture a little bit. Going back to my sheet, we can see that yes, their operating cash flow has been about $980 million for the last 12 months, but they have a lot of share-based compensation. So they give a ton of stock to their employees. It has been coming down over time, and that's something I like about their CEO. When the Lyft CEO, David Risher, came on a couple years ago, he said, hey, this stock-based compensation is ridiculous. We need to get this under control, and it has been coming down. But this is diluting us as equity owners. It's a real expense to shareholders, and it's not factored into this free cash flow number. So that's why I have this column, adjusted free cash flow, where I adjust for share-based compensation. So for me, I'm looking at about $570 million in free cash flow for the last 12 months, which is still great, but a very different number than this, $920 million. Now, LYFT gives guidance for their next quarter here. They're expecting gross bookings to be up about 10 to 14% year on year. That's great. This would be a record quarter for them. And if I just take the midpoint of the margin that they're expecting, 2.7%, that would be record margins for them as well. So really, everything seems to be moving in the right direction. One thing we haven't talked about is their acquisition of FreeNow, which is like a taxi service in Europe recently. FreeNow is a much smaller company than either Lyft or Uber, and the market kind of viewed this as a nothing burger when they announced this acquisition. So this might help growth going forward, but it's not really a big part of my thesis for this company. So coming back to our sheet, I just want to show some really quick comparison just between Uber and Lyft on some big metrics. So I'll put in Lyft, put in Uber here. We'll wait a second for our data to populate. All right, so really quick, I just want to show off how big the difference in valuation between these companies is. So Uber has about 9 times the revenue of Lyft, but in terms of enterprise value, where enterprise value takes into account not just the market cap, not just the value of the equity, but also the net debt position of the company. And Uber, the enterprise, is being valued more than 30 times the enterprise value of Lyft. Now, I don't expect this number to be 9 times the enterprise value for Lyft. I don't expect it to be the same ratio as the revenue because, again, Uber is growing slightly faster and it's a more profitable company. It has larger scale. So we should give it a premium. The question is this large of a premium justified or not? We'll take a look when we model out the companies in a moment. Going down, we see gross margins are similar, actually slightly higher for Lyft, which gives me confidence that as Lyft scales out, that they'll be able to improve their operating margin to get close to an Uber level. Again, Lyft is a few years behind Uber on this. Uber has already turned into profitability. But on just a cash flow basis, Lyft is trading for, 10 times operating cash flow. Again, this doesn't take into account share-based compensation, but still looking a lot cheaper than Uber at almost 30 times. So let's model out what we can expect to make on an investment in Uber or Lyft stock today. So I put in some assumptions for the next 5 years for revenue growth, for margins, and for the multiple that this company is going to trade at. And for my base case for Uber here, I put in that they're going to grow about 15% every year for the next 5 years. Their margins are going to improve to about 12% operating margin. And I gave them a multiple of about 25, which seems reasonable. And if my assumptions in this scenario come true, then you could expect a 12% return every year for the next 5 years for Uber stock today. That's a pretty decent return. I also have a bear case scenario and a bull case scenario here. You can see that in my bear case, I have revenue only growing 10% every year for the next 5 years, which would still bring revenue up to $73 billion by 2029. I have margins only improving a little bit from here to 10% and a 20 times multiple on the stock. And if these assumptions come true, you'd basically be flat on your money after 5 years, actually down just a little bit. And in our bull case, if revenue grows 20% every year for the next 5 years, margins improve to 15%, and it trades for a 30 times multiple, then you could expect 27% every year for 5 years. That's more than a triple on your money from here. That would be an excellent investment. So overall, pretty reasonable for Uber stock. In spite of the run it's had, I don't think it's overvalued today. But now let's look at Lyft. So for Lyft, it's not growing as fast as Uber. I assumed in my base case a 9% growth every year for 5 years on the top line. I assumed operating margins get to about 7%, which I think might be slightly conservative. It looked like to me they're about 3 years behind Uber in terms of profitability, and Uber's operating margin right now is about 8%. But in any case, that's the assumption I made. I gave them a 16 times multiple 5 years from now, which doesn't really seem that expensive. And if these assumptions come true, you're looking at a 17% annual return every year for 5 years. And in my bear case scenario, I'm assuming only 6% revenue growth, so just a little bit above inflation. Margins only reach 5% with a 12 times multiple. This would definitely be a disappointment, but in this case, you'd be, again, roughly flat on your money, down a little bit over 5 years. And my bull case is basically just what analysts are expecting for this stock, which is kind of 12% revenue growth for 5 years, margins to get to roughly where Uber's margins are now, maybe a little higher at 9%, and I gave them a 20 times multiple. And if this scenario comes true, you are looking at a 32% annualized return on Lyft stock today. That would be absolutely fantastic. Roughly a 4x over 5 years. So in spite of the fact that Uber is the market leader and I think their stock offers decent value today, I don't own them, and the company I own is Lyft. Again, just compare my base case here to really understand why this is the stock that I own. For Lyft, this is Lyft here. The assumptions I made were just 9% revenue growth, 7% margins, and a 16 times multiple. Whereas for Uber, I'm assuming 15% revenue growth, 12% margin, and a 25 times multiple. So I'm taking into account the fact that I believe Uber will have better margins and better growth and will trade for a higher multiple. And yet, if these assumptions come true in both of these cases, I'm looking at a better return for Lyft stock today than Uber. Why is that? It's simply because the valuation that you can buy Lyft for right now today is just so much cheaper than Uber, where when I put in what I think are reasonable assumptions, I'm just looking at a better return today for Lyft. Now, if you're watching this video in the future and the price of these stocks is different than the price is today, you can see what my base case implies for return right here. So in Uber stock, if Uber falls to $60 a share, then my base case assumptions, they imply a 21% annualized return for Uber stock, which would be excellent. And for Lyft, if Lyft stock goes up to, $18 a share, then my base case assumptions would be implying a 12% annualized return for Lyft stock. So at different share prices, my opinion might be different, but right now today, I think Lyft is a better buy. If you agree with me, if you disagree with me, let me know why down in the comments below. If you got something out of this video, subscribe to the channel. I think as I'm recording this, I have 199 subscribers, so maybe one of you could be the 200th subscriber here. I really appreciate everyone who's watched a video. Let me know what companies you want me to look at next, and I hope to see you in a future video.